Hi, my name is Alan Porter and my company is Strategic Wealth Strategies. What I want to show you in this segment is the difference between funding an index universal life policy, some taxable vehicle, or a qualified plan vehicle. I want to show the advantages of an index universal life policy over these other financial vehicles. Now, if you would transition to my screen, and this is very, very important for people that are contributing to qualified plans and such, or savings accounts. Let me show you what I've done on this screen. What I've done is I purchased an index universal life policy with a premium payment of $500 a month, which amounts to $6,000 a year. Immediately, my death benefit is $142,028. Okay, you can see that right here. Now, what I really want to show people, especially when it comes to retirement, is I'm going to pay on this until I'm 65 years old. My death benefit at that time will be $526,328. But the great thing about it is when I turn 66, I'm going to be getting $50,970 a year for the rest of my life from policy loans, and that's tax-free money. And that's in accordance with IR codes 7702 and 70E. And that will last until I'm 120 years old. Now, if I took that same $500 and put it into some taxable financial vehicle, you can see right here I've done the same thing. I put it in there till age 65. Actually, it's even coming out sooner than this. But what I've done also, now I've credited, everything's the same, 8.5% rate. All the fees and everything were included in my index universal life policy. The management fee here I put down at 1.5%. The management fee for the average 401k is 2.99% across the nation. Now that $50,970, they've already paid taxes. Now, I don't care if you've got a financial advisor that's telling you that you can compound interest in a taxable account. That's financially impossible because you've got to pay taxes either from the taxable account or you're going to pay it from your lifestyle. So for this demonstration, I'm paying it from the account, as you can see right here, the 30% tax bracket. All right, now what I want to show you too is I've given him a $200,000 term life insurance policy. I put the best rates, the best health rating and everything. That comes out to $376 a year for 30 years. But understand, when he's 70, he will have no more life insurance, and it's only $200,000. If you remember from the IUL, our insurance at age 65 was over $500,000, and that's tax-free death benefit. But here's the important thing I want to show you. He starts taking the money out at 65. He's going to run out of money when he's 69 years old. And he's out of insurance when he's 70. All right, everybody says, well, I'm contributing to my 401k. I said, fine, let's take a look at the 401k. All right, we've got a premium of $7,800 because this is tax-deferred money in a 30% tax bracket. All right, we've got the same crediting rate. The management fee is 1.5%. Still got the same $200,000 of insurance. Annual life premium, $376 for 30 years. But now let's look at what has happened. In order to get that $50,970 at a 30% tax bracket, we have to take out $72,814 because this is tax-deferred money, so we have to pay taxes. And that's provided the taxes don't go up, which I'm sure they're going to. But if we look at this, we're going to run out of money when we are 71 years old and we have no insurance when we're 70. I have a lot of financial planners tell me, well, insurance is too expensive. And I kind of laugh and I said, well, I'll agree with you. Insurance is expensive, but it's expensive up front. It's a front-loaded asset. It's an inverted asset. I said, what is more expensive? My insurance or your fees and taxes? So this is what I show people. I'm going to come down here to my cost comparison. We've got everything the same here. This is in a taxable account. I'm using the S&P 500. Well, let's just change it to the 8.5% here. All right, we're using everything's the same, 8.5% tax bracket, 1.5% management fee. We still have the $376 going to our term. But what I want to show you is the difference. The area in the white, the insurance is more expensive, but remember I said it's front loaded. The area in the green It's where any type of taxable vehicle or qualified plan vehicle becomes more expensive. And I'm not talking a little bit of money. I'm talking hundreds of thousands of dollars. In just this 30-year period, the taxes and fees on this small account of $500 a month is over $155,000. And remember, at the end of 30 years, this person has no more insurance, where with your Index Universal Life policy, you have over $500,000. Now, basically, in conclusion, what I want to show you is the vast advantages of an Index Universal Life policy. They grow tax deferred. You get your money tax-free by IRS codes 7702 and 70E. It does not affect taxation of Social Security, which can be an absolutely huge factor for you. Instead of paying $6,000 to $10,000 between your 401k and your Social Security, how would you like to have paying no taxes? The other thing, it reduces the means testing for your Medicare. This is just another financial strategy that I teach my clients. This is a strategy that I've got, and I'm doing it for myself and my family. I just started this approximately 3.5 years ago. I have 5 of these Index Universal Life policies on my wife and myself. We at first had $550,000 of term life insurance, which would have ended when I was 72 and my wife was 70. At that point, we would have no more insurance. We had no cash value. But doing these strategies, I have 5 of these policies now. We have almost $2 million of insurance. And our cash value, or not our cash value, but the cash that we can take out in policy loans is going to be over $100,000 a year, completely tax-free. In our tax bracket, that's about $157,000. But again, this is something that a lot of people don't know about. They haven't been told about it, and there are certain reasons for this, and I'll explain that to you when we meet. But if you have any questions, again, my name's Alan Porter, my company Strategic Wealth Strategies. Call me at 910-551-1046. Thank you.